with specificity the day and hour that the Dow will hit 50,000. So we're really looking forward to that. But at the Community Foundation, we brought in the Cornerstone folks, Tina, what was it, maybe 12 months ago? About a year and a half ago to take over our investment advising, and honestly, they have been wonderful. Their presentations are superb, really informative, and they've done great things for us. And we thought it would be an important opportunity today for you to have a chance to hear from them and mingle with them and talk to them about their philosophies and their skills and expertise, and if nothing else, just a chance to get together and again, thank all of you for your support of the Community Foundation. So with that, I'm going to turn it over to our still relatively new Executive Director, Tina Barber, who's also doing a great job. And Tina, I'm going to transfer the mic to you.
All right, I love it.
Probably just stand here and hold this.
Yes, please. Thank you, Mark. How accommodating. All right, does that work? I'm just going to hold this. How's that sound? So I want to thank you all for taking the time to join us.
Am I really going to hold
You're
this?
really going to hold it, I think, because I've got this I'm holding. All right.
This is the
We'll be here all week.
This is the kind of teamwork you see
Exactly.
Servant leadership.
every day.
There's an extra chair, you can put it on.
No, that's all right.
So,
Thank you.
when we were arranging this event to have you meet the folks from Cornerstone, it occurred to me that many of you might not have formally met our internal staff and some of our board members. So I thought that we would start there. So our board members that are present today, you've met Mark, he's our board chair, our most excellent board chair. And we also have with us today Greg LaMonica from Norwich Wealth Management. He is a fairly new board member, Shenango County resident. And we also have Sean Wolbert with us. She's the CEO of GHS Federal Credit Union. And she will be she is our vice chair. See, it hasn't been so too long, and I almost know what I'm doing. So we appreciate you being here today. But at the center of this organization, right, and the whole heart of the endeavor is our staff, all right? And I consider myself truly one of the luckiest people in the world to have the team that we have. We were talking today about there are tissues all around the office. And the reason for that is we don't spend a lot of time crying, but we spend a lot of time laughing. They are creative, they're funny, they're super committed, but I'm going to have them introduce themselves because I want them to tell you what they can offer to support our donors. So I'm going to start with our brilliant finance officer, Darlene Sempa.
Am I still?
I can do
functions?
Oh, I got it.
Hi, is this good? Hi, I'm Darlene Sempa. I'm the finance officer. I've been with the foundation for just over 10 years. I absolutely love it. Currently, I work with donor advisors. I do all of the granting for the donor advised funds, and I do all the scholarships. I also answer all the questions on investments. Just do a variety of things, but I'm always available to answer donor questions. Anything somebody might know, I'm happy to answer.
Thanks. Thank you. So then we're going to go, and I'm just going to travel. Is that okay if I travel? Okay. I'm just going to travel over to Stacy Master Giacomo. Stacy is our program officer.
Hi, I'm the program officer. I've been here about 5 years. I am responsible for running all of our grant programs. So I can really, as far as donor goes, be that bridge between your philanthropic needs and goals, and our community needs. I have really great relationships with all of our grantee partners, so I could be that for you. And I'm also going to be setting up some summer site visits, and we're going to put those out to see if anyone would like to join us. It's a really great way to see what's going on the ground and get to know our community better.
Thanks, Stacy. More recent addition is our development officer, Sean Graham.
Good afternoon. Thank you so much for coming out to this little thing that we put together. My name is Sean. I'm the development officer. I've been with the foundation for 6 months and 1 day. So you might get a call from me or an email if you haven't made your yearly disbursement, or if we have heard from Stacy that the community has a particular need and we think that maybe your fund might be a great fit for it. And you'll get some reminders from me. And I also do the bulk of the design and advertising work.
Thanks, Sean. All right, and where's our Shayna, our most recent addition, Shayna Orwin? She's our office manager.
I sat in the worst spot. I'm gonna 360 turn. So Shayna Orwin, I am the new office manager. I've been here since April 24th, so only a number of weeks. And so when you call, you will hear my voice. If you step into our office, I probably will be the first face you see, and then I will send you in the appropriate direction of all of my coworkers.
Thanks, Shayna. Thank you. So one of our major priorities at the foundation is to focus on strengthening the service and support that we're offering for our donors. And to that end, we will be increasing the frequency of our communication with donors and offering more opportunities for engagement. We're really excited about this. You know, such amazing things happen in our region because of your investment. I mean, I look around at the donors that are here and I think about some of the projects that you've supported and the nonprofits that you've supported. And it's, you are responsible for helping them carry out their mission. So we really appreciate that. I just want to say that so on your tables, you're going to find our most recent newsletter. Okay. And that highlights the interesting things we're doing with our housing trust fund, our comprehensive regional need assessment, which was just finished. We'll be rolling that out over the next month or so. And we also thank our donors who contributed to our hygiene product fund, which was very successful, and we appreciate your help with that. Last year, we made over 550 grants and scholarships, and we pushed $3.3 million out the door. This year, in our first 3 months, we're already at $1 million that we've pushed out the door. So we're on track again to have a record-breaking year. So we fund everything that you can think of. Just this year alone, we've invested in projects ranging from the safe removal of over 100 farm animals in New Berlin, which is very recent, to the expansion of the Broome Tioga BOCES LPN nursing program, and that's just this year. And there's a million other things that we do, and your investments help us do that, which is a good segue. We're talking about investments, to introduce the folks that are with us today from Cornerstone Independent Asset Management. As Mark said, we chose Cornerstone because of their performance, their professionalism, and the passion for the work that they do. And they do it all in a very accessible way. All right. So when I think of our old fund investment managers, I used to catch about maybe 20% of what they were saying. And we're up to about 75%. So,
Heading to 100.
Exactly. So with that, joining us today are Tyler Papez, Senior Director of Private Wealth, and Kevin Karpuk, Chief Investment Officer. I'm going to turn it over to Tyler.
Thank you. Set this over here. Are you going to hold this for me the entire time?
I'm going to hold this the entire time. Oh my goodness gracious.
I'm just teasing.
I thought that's why I was here.
No, that's not part of it.
I actually move around way too much for somebody to hold this for me. So let me just slip this into my back pocket and we'll get started. All right, well, welcome everyone, and thank you for having us. My name's Tyler Papez. I'm a principal with Cornerstone. With me is my colleague Kevin Karpuk. He's our Chief Investment Officer. And today, let me just share with you what we have on the agenda, okay? Beyond just introductions, we wanted to make sure everyone here understood a little bit more about Cornerstone, our footprint in the area, our investment philosophy, our process, our mission, and the team that serves this organization. We're going to pivot from there to talk about the markets. And one of the things that we talk about with this committee and all of our clients is this idea of balancing what we see right in front of us with this longer term view. So we'll talk about some of the things that we see right in front of us. And they're things that everyone in here probably reads about or hears about or watches. Right? I'm talking about international conflicts. I'm talking about uncertainty around interest rates. I'm talking about an election coming up, right? How do you capture those things in a portfolio and in the work that we're doing today and balance that with this longer term view, right? This money is meant to last forever. So how do we capture both of those items? And so for that reason, we'll pivot from an introduction to Cornerstone with an overview to what we see in the markets right in front of us to a longer term view, something we refer to as capital market assumptions. These are forward-looking expectations on the markets. Before we get started, I'll just comment that whenever we're being onboarded or onboarding a client, one of the things that we look for is really good communication and a really good cultural fit. And I could say with a high level of confidence that we have that here. The team that we've been working with has been excellent, and I applaud the foundation for the transition of leadership roles and just the transparency that was provided to us and to other stakeholders. Really well done there. So with that, we'll get started. The first thing I want to call out on this slide, and actually they gave me a laser pointer here, is what you see right over here on the left. It says ESOP, proud to be 100% employee owned. A lot of people don't know what those initials stand for. It's an employee stock ownership plan, but that's really kind of a unique part of Cornerstone. We are 37 employees, and each employee is an employee owner, right? So yesterday we had our review meeting, and afterwards Darlene was talking about how wonderful it's been to work with the investment operations team. And I probably should have reminded you at that point, Darlene, that, well, they're all owners of the company. Every person that you interface with at Cornerstone has an equity stake in the company. And so it keeps all ships rowing in the same direction, and it puts us in a situation where we can really serve our clients. This is an overview of the company from kind of a 40,000 foot level. We consult to over $7 billion in assets. We have what I believe is an unusually high client retention rate. You see that at 97%. We have had to prove that to the SEC, and we've done that successfully. Otherwise, we'd not be able to show it here. We have a lot of smart folks that work at the company, and part of that is because of where we're situated geographically. There are a number of prestigious schools in the area, and we've been able to attract and retain talent from the likes of Moravian, Lehigh, Lafayette, Villanova, Kutztown, Millersville, and obviously schools outside of that as well. On the right-hand side, you see some of the awards and recognition that we've received. On the top left here, oh, I pressed the wrong button. I was warned that that would happen, and not to press the top button. So I broke that one. Let me go back here. Here's my laser pointer. So we've been recognized as a top RIA, a top registered investment advisor. We've been recognized 5 out of the last 6 years as best places to work in money management. And that's kind of a really interesting one because they survey every employee. So all it takes is one disgruntled employee to kind of move you off that list. So that's really neat. And then Barron's and the Wall Street Journal has us ranked as a top institutional investment consulting firm. And actually, we just received news, was it yesterday, that we are being recognized for that again this year. And then on the bottom right, NAP is the National Association of Plan Advisors. We're recognized for our work in the defined contribution space as well. So when I explain Cornerstone to people, one of the first things people want to know is what's our mission. And our mission is listed here. If it's difficult to read, you guys have the handouts in front of you. But I tend to think of it as a math equation, right? It's helping our clients meet the highest fiduciary standards. It's recognizing and responsibly managing risk. It's controlling costs. And if we could do those 3 things and do them well, then we can drive performance and results. The other thing I want to remind people with that first bullet point about helping our clients meet the highest fiduciary standards is that regulatory bodies set minimum standards And our goal is to meet the highest standards. And often there's a world of difference between the two of them. I was talking to someone earlier and they asked where we're located. We're in Bethlehem, Pennsylvania. It's 2 hours and 10 minutes south of here. So it's actually closer than I think some people think it might be. But we do have clients in 23 states. The majority of our clients are in Pennsylvania and its contiguous states. So we think of this region here as kind of our power alley, right? From Rochester down to DC, from New York City out to Pittsburgh. That's where the overwhelming majority of our clients are. We're really proud to serve this organization and this community as a whole. There are a number of foundations and nonprofit entities that we've worked with for 2 decades in this area. The Meet Charitable Foundation is an example. The Roger Kresge Foundation is an example. St. Thomas Church, St. Patrick's, and the Conrad and Virginia Clee Foundation. So we've been coming to this community and serving this community for a very, very long time. Organizationally, this is how we're set up. You can see kind of these 4 branches of Cornerstone that all fall under this header, Cornerstone Independent Asset Management. I'll talk in a little bit about what it means to be independent, but in short, it means that we are not tied to any other financial intermediaries. We're not tied to a bank, we're not tied to a wirehouse, we're not tied to an insurance company. We're completely independent. And under that, you've got these 4 different areas. You've got institutional consulting. That's what we're here to talk about today, is our work with the Community Foundation. Institutional consulting is, without a doubt, the engine that drives Cornerstone. Institutional consulting represents approximately 60 to 65% of our revenue every year. It is the business that really kind of feeds these other parts of the company. And these other parts of the company kind of came about based off of demand. So the second one you see there is private wealth. So we do have a private wealth business that represents roughly 30% of our revenue. And most of our private clients come to us by way of our institutional relationships. Right? People see the work that we do at the institutional level, and then they'll ask for some help with their situation. We've got insurance consulting, which kind of gets integrated to both private wealth and to institutional consulting, very niche types of insurance, and then philanthropic consulting. And this is kind of a really neat one. Philanthropic consulting supports our institutional consulting by helping organizations further their development efforts. There are a couple people in here that completed their CAP designation, which was led by this part of Cornerstone. CAP stands for Chartered Advisor in Philanthropy. And Sean, who introduced himself earlier, is in the second cohort of that program. And so from our perspective, that's really kind of neat, is that we've got professionals here who've been doing this for a while and are still committed to that continuing education. So hats off to you. In terms of the team, it's kind of funny to see my picture up there, but that's me, Tyler Papez. I've been with Cornerstone for 11 years come June. I grew up in New Jersey. I studied economics at Lafayette College. I have an MBA from Lehigh and a master's in taxation from Villanova Law School. Kevin and I work very closely together. It's easier for me to say this when he's not here, but he is very much the brains of the operation. He's been with Cornerstone for 24 years. What's really interesting is Kevin, and you can see he's got just a ton of designations. He's got a Bachelor's of Science in Economics from Lehigh University, a Master's in Economics from Lehigh. He's a CFA charter holder, and he's got a ton of different securities licenses as well. But Kevin was actually a scholarship recipient of a Cornerstone scholarship 25, 26 years ago, interned with the company. The company fell in love with him. He was hired as an analyst and worked his way up to the role of Chief Investment Officer. And he's been serving in that role for quite some time.
I wouldn't leave. They were like, the internship's done. I'm like, but that chair's empty. Finally, they had to put up with me.
And this is a lot of the team that supports us behind the scenes. You know, often Kevin and I might be the face of this relationship. He and I are the people that come up and have these meetings, but there's a team behind us. Tiffany Gilbert is our Director of Client Service. Ryan and Trevor are 2 senior analysts, and then you've got an investment operations team down on the bottom who does a lot of the day-to-day work. And as a company, this is how we're organized. In that first column all the way to the left, you've got consultants. We've got a team of client service personnel. We've got our analysts, and then core services, marketing, technology, etc. Again, every name that you see there has an equity stake in the company. And by and large, we are serving institutional clients who sit in a fiduciary role, right? And so that is very much what our focus is. And our investment process and philosophy is kind of built around that. So I mentioned this idea of being independent. Part of being independent is following what we refer to as an open architecture solution, where the client is in the middle, and then you've got these other pieces to the puzzle, the other pieces to the investment solution that we are intentional about separating, right? Where we operate as the consultant, we can custody the money at an independent third party, U.S. Bank in this case, but we work with Schwab, any number of custodians. We go out and hire best-in-class money managers, and from a brokerage perspective, we lean into best execution. Okay? And the reason that we separate these responsibilities is to create more transparency for clients with respect to fees, with respect to roles and responsibilities. And we follow this belief that by separating responsibilities, it leads to greater accountability. We talk about fiduciary process a lot. I think people get stuck on the word fiduciary and they forget about the word process. But that's really where our emphasis is this idea on process, right? And this idea of continuous improvement. And when we first got hired, and Darlene, you would remember this well, I mean, we really focused on kind of organizing everyone's roles and responsibilities. We spent a lot of time developing an investment policy statement, and there was back and forth there to make sure that this investment policy statement captured the direction that we wanted to go and gave us tight enough parameters that we couldn't deviate too much from it, but it was open enough that we could take discretion and have tactical tilts within the portfolio. And then from there, we implemented the portfolio, which will show you what that looks like. We'll actually conclude with that today. We'll talk about portfolio structure, and then we monitor it. And there's a formal monitoring process that takes place every quarter. And it actually just took place yesterday. And it was funny. Yesterday, going into the meeting, a couple days prior, Kevin and I were preparing, and the numbers looked really good. I mean, almost like too good. And we talk about sometimes like, all right, what do we need to focus on in this meeting? And our focus yesterday when we went through the performance numbers was just to remind people that it's not always going to look like this, right? It looks really good now, but we're going to have quarters where, we might be under benchmark, or we might be in the, third quartile relative to a peer group. So later on, I'll call out some of those numbers just so everyone has a sense of performance relative to benchmark and where you guys stack up relative to a peer group of other foundations and endowments. So the timing for this meeting couldn't have been better because those numbers look really, really good. Our investment philosophy is very much focused on risk. And sometimes the way I would describe Cornerstone to people is it's almost marrying these two concepts. One is fiduciary best practices with this idea of responsibly managing risk. And I'm not going to read all of these, but our investment philosophy is rooted in this idea that returns are a byproduct of risk. Right? The market is going to do what the market does, but our role is to really kind of understand the level of risk that we're taking in the portfolio, the sources of those risks, and how we can manage it. Risk is not ambiguous, right? You can benchmark it, you can put it against peer groups, you can put it in motion. And risk is important. Sometimes people think of risk as having almost a negative connotation, but you need it in a portfolio to target rates of return. And we'll kind of show you that in a little bit, right? How your asset allocation, how the amount you have allocated in stocks feeds into a best case scenario and a worst case scenario. And it's a matter of getting comfortable with those. Because we have our Chief Investment Officer here, I'll pause for a second and just see if you have any other comments to add here.
Yeah, I would just add, and Tyler mentioned it, but we do talk a lot about risk, but it's unnecessary risk we don't want. We don't want to have a day where the market's up 2%, the portfolio's down 5%, and we don't understand it. We want to understand risk, and Tyler will show you in just a second. We can actually measure it out and say to clients, if you were to lose 10%, would he be out of business? Right? And if they say yes, we can dial the risk up and back. But I do think, one of the things we've learned over time, and it should be an investing 101 staple, is that negative returns just kill long-term portfolio returns. So I'll ask a math question, and whoever gets it right gets to have dessert, which we should pause in a second. But if and no answering from the guys who know the answer. But does anybody off the top of your head, if you lose 50% in a year, so if you go from $100 to $50 in your account, how much do you need to make the next year to get back to where you began? What was that?
100%.
You need to make 100, so you lose 50, and most people say, oh, you just need to make 50% back. That only gets you to $75, right? So over the long term, adding value around the corners and protecting from significant drawdowns are how you win. And then, I'll be honest, getting the heck out of the way and letting, the market's going to go to 40,000, it's going to go to 50. Tyler will tell you when shortly. But the key is to be in the game when the market's moving forward and protect on the downside. Our investment policy committee meets regularly, and there are times where we'll add some more cash, or we'll become more defensive, or we'll become more aggressive depending on what's going on. And I would say one of the things the Community Foundation, like a lot of other institutions, have come to realize is by us having discretion, we can take a less emotional view to the long-term management of money. A lot of times, if a board or a committee has to decide, do you want to buy or sell? Well, if the market's down 15%, I don't know many humans who say, let's go all in. They say, well, it could go down another 15. We have the authority within our ranges to dial risk up and back. And a couple things happen there. One is, we are compensated to grow the assets. But number two, we also create a fiduciary safe harbor for your committee and board and staff, that their job, and you listen to everybody's jobs, they need about 10 more staff members to actually do all the jobs that have to be done. They don't have time to be the investment experts or to look at it every day and try to decide where to allocate the assets. So as long as they set policy, which was step one, and monitor regularly to make sure we are doing our job and staying within the investment policy, you know, the board, the committee, the staff are doing their job. So that, you know, there are a lot of different types of risks out there, and you know, the foundation has been really mindful at identifying and mitigating the risks that aren't beneficial and leaving the possibility for where risks can add excess return for us to take advantage when appropriate. So maybe, but no, that dessert doesn't look good. So do we want to pause just 1 second?
It's up to you. Or you guys can just come up and help yourselves. I don't know, the video's rolling, so I assume we should probably just keep going. But I would invite you up to grab one if you wish.
I'm bringing it around.
We're coming to kind of a close of the introduction to Cornerstone, but again, there's the investment philosophy, right? That returns are byproduct of risk, and I think Kevin really kind of drove that point home. That's where our time is spent, is really understanding the sources of risk within a portfolio. We'll pivot now to talk about the current market economics. The macroeconomic environment. And this is what we're looking at, an S&P 500 chart. You can see there's two charts here, right? This one goes back to 1995, and then we've got this 1 year view. I just want to point out a couple things. Number one, here's COVID, right? Here's COVID in 2020. Market dropped about 30% in 31 trading days, 34 trading days, something like that. It was really tempting for investors to hit the panic button. In fact, one of the questions I asked students this week we're hosting, I think, 8 externs, which is really neat. You get these young, ambitious students in to learn about the world of investment consulting. And I asked them, I said, when do you think was the last time investors were really emotional about the market? And everyone points to COVID. And I said, was there a more recent time? And I would point to early October last year, right? The start of a new international conflict. That was coming off of a soft September. Market was slightly down in September. Then there was an attack in October, and it was really easy to hit the panic button. Right? You still had a war going on in Ukraine. Now you had this new international conflict in Israel with, most major players posturing in some way. And it was an easy time to be emotional about the market. But if you look here, here's October 3rd, October 5th, 6th, and then you can see the market ran, right? Almost the opposite of what that nervous investor expected. And the question becomes, well, why did the market run like that in November and December? And why did that happen? Any guesses? Much of it was off the prospect of a lower rate environment. I'll show you a slide momentarily that shows the Fed funds rate and how it increased to combat inflation over the last couple of years. And the market really moved in that northeasterly direction in November and December off of expectations of rate cuts this year. And the reason that's important is because in the high rate environment we're in right now, it has a real influence on spending, right? Anyone that's gone to purchase a car notices that the loan rates are much, much higher today than they were a couple years ago. Same thing with housing. Same thing with personal loans, home equity loans. Think about it from a company's perspective, right? A company that wants to build a new plant or purchase new equipment. The rates associated with that are much higher than they were. So the market ran on the expectations that we would see 6 to 7 rate cuts this year. While there's a lot going on out there right now, it is our belief that the main story continues to be inflation. And when I say there's a lot going on, I'm talking about interest rate uncertainties, I'm talking about international conflicts, you've got, protests, and you've got an election, right? No one's going to forget about an election coming up. There's a lot of uncertainty. There are a lot of headlines. It is our belief that inflation is still the main event. That is the Fed's focus, and what the Fed does matters. What you're looking at here is labor supply, and this idea that the unemployment rate continues to stay at a really low level. It's currently at 3.9%, and the labor supply has an influence on that. On this page, here we really focus in on inflation. And I bet everybody in this room has kind of their own unique inflation barometer. Every client seems to have one. It could be, I don't know, for some it's the price per pound of a filet mignon. For others, it's a stamp or a gallon of milk. For others, it's their auto insurance or their health insurance. But it's something that everybody feels right now. What we're looking at here is where inflation peaked, just north of 9% in summer of 2022. I'm sure a lot of people remember that. We saw those Fed rate increases, and inflation came down to a much healthier level. It went from 9% to the mid-3s. Now the target long-term rate on inflation is to get to 2 to 2.5%. And inflation was there pre-COVID. But through all that stimulus we did to kind of combat COVID and move the economy through it, we created this inflationary environment. Then the Fed started to raise rates, deliberately trying to slow down the economy and slow down inflation. And we got to what I think were nearly healthy levels in that 3 to 3.5%, with the goal being 2 to 2.5%. And then you can see what happened just in the last couple of months. You can see just a little bit of an uptick. If you look on the right-hand side, where you look at some of the services, you've got education. We've got a professor here. We've got auto insurance, recreational services, medical services. These services tend to be stickier. And sometimes I love that economists use terms that, to me, really make sense. They'll actually categorize inflation based off of sticky or not sticky. Like, those are the two descriptors. Sticky basically means like it's got some staying power, right? Once the prices go up, that's the new normal. These tend to be sticky, right? Once the price of auto insurance goes up, or the cost of education or tuition goes up, it tends to be the new normal. And you can see the uptick that we've experienced here. And so I want to pause for a second, and I want to just kind of frame up how I think about it, okay? And I wrote about this back in January. It wasn't a popular enough write-up that it would have made its way to you. But I'll frame it up in a way that at least makes sense. And I give you something that I kind of visualize in my mind's eye. I wrote about this idea that almost feels like the economy is on a knife's edge. Right? And you can kind of picture if you're holding a knife and there's a ball on top of it, and the ball is going to roll to the left or to the right, or it could roll right down, right? And if it rolled right down, that's the Fed threading the needle, right? That's the Fed lowering rates at precisely the right time so that they keep inflation low, but they keep inflation low in a way that doesn't disrupt the labor markets, so we don't have big layoffs, and it doesn't disrupt economic growth. And that's what is referred to as a soft landing. That's what everyone wants. Some would argue that it's unachievable, okay? That it's never been done before, but you'll read a lot of headlines on a soft landing. And it's just this idea that the Fed threaded the needle. Now, the other ways that the ball can roll to the left or to the right are really influenced by the Fed. So one scenario is if the Fed lowers interest rates, and I'll jump ahead because here we're looking at it, right? Here's COVID, interest rates came to zero. We had that inflation, we had these interest rate increases. The one good thing about it is we're all getting some yield on our cash right now. We're getting yields on bonds, that's a nice thing. But now we sit here and we say, well, where is it going to go from here? Now the risk, and go back to that, the ball rolling off the knife, is that if the Fed cuts rates too soon, if they cut rates prematurely, then the risk is we get a second wave of high inflation, right? We get a second wave of this high inflation. And I would submit to you that that would be punitive to everyone. That would be punishing to everyone, but particularly to people at the lower end of the socioeconomic spectrum, right? It would price them out of basic necessities, food, shelter, etc. And moreover, if the Fed lowered rates prematurely and it led to this inflation, they would have to start increasing rates again, right? We would be on kind of wave 2 of marching upwards on the rates. Now, does anyone know what the risk is if the Fed waits too long to cut rates? If we have this high rate environment for too long, what can happen? Yeah, exactly, a slowdown or a recession, right? These high rates are kind of dampening spending and big purchases. It could lead to a slowdown. So the question becomes, well, which is the least imperfect option, right? If you were the Fed, where would you lean? And all signs are pointing to the Fed would prefer a scenario where there's a slowdown than a second wave of inflation. And that tells us that we're probably going to be in this higher for longer rate environment. There are things that the Fed is doing actively to take liquidity out of the market, and that's illustrated here. Again, it's another tool or arrow in their quiver, you can say, to control money supply and thereby lowering inflation. You can see when you look globally, other central bankers, when you look at the European Central Bank, the Bank of Japan, the Bank of England, are all kind of grappling with these decisions as well, right? Everyone raised rates to combat global inflation, and the question becomes, when do we start to lower them? So this is not a challenge that is unique to the US. I'm going to just shift away from the rate environment for a moment and talk about what I would refer to as a phenomenon that we've been seeing for the last few years, and it has to do with market concentration. Okay? Market concentration refers to this idea that there are a handful of companies that are really influencing the market in a big way. Can anyone guess the name of one of those companies?
Apple.
What's that?
Apple.
Apple, perfect. Apple would be one of what we refer to as the Magnificent Seven, okay? And those Magnificent Seven stocks are really those big tech stocks, right? Apple, Meta, Amazon, Nvidia, Google, Microsoft. And I know it's difficult to see here, but I just want to focus on these top 2 rows. And I want to point out that last year, the Magnificent Seven, those 7 tech stocks, were up 76%. The rest of the S&P 500 was only up 8%. Now the S&P 500 as a whole was up 24%, but you just want to remember that most of that was attributable to these 7 companies. Right? So one of the things that we've done in the portfolio is we've deliberately added managers that diversify away from big tech. We know that we have that big tech exposure, but we want to manage that concentration risk. It goes back to one of those earlier slides when we were talking about risk and the opportunities we have to kind of control, to ratchet risk up or down. And one of the reasons we want to do that is if you look on the right-hand side, those big tech companies, their valuations are a little bit stretched. Right? They're more expensive when you look at PE ratios, price earnings ratios, relative to other companies. Right? So when you look at pure fundamentals, it tells you, right, we want to make sure we have that exposure, but we also want to make sure that we have hedges in the portfolio in the event that this happens. Right? You can see in 2022, the Magnificent Seven stocks were down 40%. Where the rest of the market was only down 8%. The last thing I want to say about the environment that we're in right now, and I think this is kind of a nice thing, right? Now that we're here, there's yield that's available to us. What you're looking at here are different fixed income instruments. I'm not going to go through all of them, but I'll just focus on this one. If we look at U.S. Treasuries, this pink bar here just shows that the 10-year median yield, or call it, roughly the average yield on Treasuries over the last decade was 1.8%. That's not very much yield at all, right? That wasn't enough to outpace inflation. Right now, Treasuries are yielding around 4.8%. And so if I was asked to identify the biggest change that I've seen in the last year with respect to portfolios and opportunities in the market, it would be that these safer asset classes, cash and fixed income, are in a position to contribute positively to the return environment going forward. And in a moment, I'm going to show you what it looked like over the last 10 years. And you'll see something that you all probably already know, and that is that stocks contributed to performance over the last 10 years, and bonds didn't contribute very much at all. What this is suggesting is that these safer asset classes, on a going forward basis, should be additive to performance streams in portfolios. And if you think about it, that's a really nice thing, right? That investors can rely on these safer asset classes to contribute to returns. With that, we're going to shift ahead and we're going to look at capital market assumptions. As we looked at these forward-looking capital market assumptions, I just want to pause here for a moment and give you a snapshot of the last decade. And this is that slide that supports what I was just talking about. The Russell 3000 index, so you think about the US stock market, that's what we're talking about, large and small cap equities, up 196% over the last 10 years. And look at bonds, the Bloomberg Aggregate Index, up 19.7% over the last 10 years. And so the takeaway as an investor is that we've been fully dependent on stocks, on risky assets over the last 10 years for returns. And we've not been able to expect much out of bonds at all. And I'm going to give you an image that we call it risky business, that people who are in this room who have been investors for a while, I think are going to be familiar with this. It's a really interesting way to think about risk. What you're looking at are 4 different portfolios. All the way on the right, this one's from 1994, one from 2009, one from 2022, and one from 2024. And they all have one thing in common. What they all have in common is they are all constructed to target a 7% rate of return. And for those of you who don't know this, the 7% rate of return, it's almost like the holy grail of returns in the investment consulting world. Because most nonprofit organizations have a 4.5% to 5% spending policy, and they still want to grow the asset pool to keep pace with that longer term 2 to 2.5% inflation rate. So if you earn 7%, you can do both of those. You can spend that 4.5% and still grow the pool of assets to keep pace with inflation. And what you're looking at is in 1994, so what's that, 30 years ago? 30 years ago, you can have 85% of your money in bonds, 85% of your money in safe asset classes, and target a 7% rate of return. This number here, 5.7%, that's a risk metric. It's standard deviation. And I just want you to kind of hold that in your head for a second as we pivot to 2022, right? In 2022, interest rates were still at 0, right? So in 2022, for a portfolio to target 7%, the portfolio had to have 96% in risk assets. US stocks, international stocks, private equity, and just 4% in bonds. And basically what that means is from 1994 to 2022, investors had to take 3 times as much risk to target the same rate of return. And so most investors said, I'm not doing that. I'll dial back my return expectation. I'm not willing to have that much equity exposure in the portfolio. And what you see here is in 2024, where we are now, and this is simply a product of the interest rate environment that we're in, we have that opportunity to have a portfolio with less risk, still targeting that 7% rate of return. And that's very good news. And it's fairly unanimous sentiment. What you're looking at here, these are annual surveys put out by some of the largest asset managers in the world. You've got BlackRock, you've got Bank of New York, you've got Callan, Veris, and what they do is they put together these forward-looking expectations every year on these different asset classes. We are not going to go through every number, but I just want to point out a couple things. Number one, on average, and I should have prefaced this by saying, all these numbers in the white rows, they're 10-year numbers. Okay, so we've pivoted from that macroeconomic environment that we see in front of us to what's the 10-year environment look like? Okay, so this is kind of the last segment of what we're going to be discussing. And what you can see is if you just focus on U.S. large cap, which is by and large it's where most portfolios have the most exposure. The Magnificent Seven companies think, the S&P 500. The 10-year forward-looking expectation is for those stocks to give us about 6.5% on average per year going forward. Now we know it's not going to be 6.5% every year. It's going to be ups and downs, but when we look back after 10 years, we would expect about a 6.5% rate of return, which is good, but it's a lot lower than what we've got in the last 20 years. The last 20 years, we've gotten closer to a 10% rate of return. So the takeaway there as an investor is that forward-looking expectations have come down relative to what we're used to getting, okay, on stocks. Forward-looking expectations on stocks are lower than what we're used to getting. But now look over here. This is really interesting. If you look at bonds, forward-looking expectations are 5%, and we've only been getting 3% the last 20 years. The last 10 years, we've only been getting 1.8%. So forward-looking expectations on bonds, and look at cash. Cash we expect to get about 3.5% over the next decade, compared to what we've got in the last 20 years, much lower. So our role is to kind of capture this in the portfolio. And what you're looking at here is how different risk profiles will lead to different return outcomes. Again, I won't go through all of these, but this first column of numbers is a portfolio with no money in stocks, which means it's 100% in bonds. And this grouping of numbers here, in my mind's eye, I visualize a bell curve, right? The median outcome for a portfolio with no money in stocks, all in bonds, is you get about a 5% rate of return. In a really good year, you can make 11%, and your money's pretty safe, right? Your downside exposure is very limited. Now compare that to over here, a portfolio with 100% in stocks. It's a risky portfolio, right? And if you're going to take that risk, you better get compensated for it. So from a return perspective, you would expect about 8%. And you can have a really good year, like last year, but you need to stomach losing 20%. So think about it through the lens of the community foundation. If it's a $43 million pool of assets, a 20% drawdown, it's $9 million, right? You think about what that money can do for the community. And so the challenge for the community foundation is say, well, how do we target a rate of return that is going to allow us to meet our spending needs, that's going to outpace the long-term rate of inflation and still offer downside protection? All of this is captured in the investment policy statement, right? That formal component of the fiduciary process, and this is really where we land, in that 60 to 65% range, okay? So that we're still targeting a rate of return that is higher than that 7%, but we're doing it in a way where we're protecting some on the downside. Yes, we need to be prepared for volatility. Yes, we need to be disciplined investors when that happens. And how we do that is by having a really well-diversified portfolio. You can see within this portfolio, as we sit here today, and it will continue to be the case, we've got approximately 45% in U.S. equities compared to 18% in international. So we've got a bias towards the U.S., right? For every dollar that we have in international equities, we have $2.50, $3 in U.S. stocks. So we've got a bias towards the U.S., and you can see we've got these lower risk asset classes fully built out. And I'm talking about fixed income and even cash. We're maintaining approximately 5% in cash. And so we've constructed this portfolio to address those two ways I introduced earlier that the economy can fall. Right? I mentioned if the Fed lowers rates too quickly, you can have this second wave of inflation. Well, the ultimate hedge on inflation is exposure to equities. And we have that fully built out here. If you're concerned about a slowdown or recession, it tells you want to have those safer asset classes. And we have that here as well with our fixed income and our cash. And then we have these other inflation hedges with a couple of alternative managers to round it out. And so this portfolio, I wasn't going to remember the numbers, but I'm going to wrap up and open it up for questions by just rattling off a couple of numbers. In the first quarter, the portfolio was up 5.1% relative to a benchmark that was up 4.9%. That 5.1% from a peer group perspective of other foundations and endowments across the country that are under 100 million, put it in the 36th percentile. So top half of the peer group relative to other foundations and endowments. This is interesting. The 1-year return number is 15.6% relative to a benchmark that was up 14.7%. So that's almost a full percent of outperformance. It's what we would call 90 basis points of outperformance. From a peer group perspective, the 1-year performance is in the 23rd percentile. That's the top quartile of endowments and foundations across the country. And then the 3-year number, right? The 3-year number, the performance is positive 5.6% relative to a benchmark of 3.8%, putting its performance in the 10th percentile. So the top decile relative to an independent peer group of other endowments and foundations. I'm going to pause there. I'm going to open it up for questions, but I'll just share with you again that one of the things that we take a lot of pride in is being accessible. So that to the extent you have questions in the future, beyond the ones you might ask in a moment, certainly reach out to us. I want you to remember that our focus is on the fiduciary best practices and marrying that with risk, and then balancing out what we see right in front of us with the market and that longer term view. And so with that, I will pause and open it up for questions.
I'll start.
Sure.
This portfolio you've created encompasses all the funds within the community foundation. In other words, the donor advised funds and the community fund, they're all in that same philosophy, that same umbrella.
Yeah. There's a sleeve within the portfolio that's managed by LESCO, which is a separate financial entity that a handful of donors used, and we've integrated that into the portfolio. But yes, every type of money that is under the purview of the foundation is captured in there.
Just to add to that, unendowed funds can choose to be in the money market. So there are some unendowed funds that are just receiving the money market. And then the one fund that's at LESCO Financial is one specific scholarship fund that was managed through that. So pretty much the great bulk of our assets are in these funds.
Next question?
Sure. Do you invest in assets other than stocks and bonds, and if so, what are they?
We do. You want to take that?
Sure.
I can pull it up here.
Yeah, if you want to go back We do have two investments that are not daily liquid. Everything else you see here, we could have liquid in a day. One, the Corbin Pinehurst Multi-Strategy is a hedge fund, fund of funds. It uses underlying stocks and bonds. And then we do have a small allocation to some private equity, not traditional private equity where you're locked up for 10 or 15 years. It has quarterly liquidity. But one of the things we have been discussing internally was one of the reasons you needed alternatives over the past decade was your bonds were giving you 1%. Now that bonds are giving you 4, 5, 6, 7%, they become a little less attractive, which is why we're underweight our allocation target and trying to decide internally how much, what value will these add over and above traditional stocks and bonds. But we do have, if you're wondering, there is no crypto. There's nothing like that. And right now there are no investments in direct real estate or anything, but these are all options that, we have that are currently, not allowed in the policy, that if we wanted to add, for example, farmland, it would be a discussion with the committee and a change to the policy. But so you'll see, 87% of the assets are in traditional stocks and bonds.
Other questions?
Tyler, I've got one.
You said back in November the markets got kind of revved up because of that anticipation of maybe as much as 6 rate cuts. That clearly didn't happen, yet today the Dow hits 40,000. So what's accounting for the continued optimism despite the fact that the Fed's holding the line?
Yeah, I mean, it's a really good question. And it's a really good point, too, because it's a little confusing, right? And the market rallied in November and December on these expectations of Fed rate cuts. And then the market kind of continued in that direction in January, February, and March, even as the market was adjusting to, we're not going to get those 6 to 7 rate cuts. I think that's why we saw a little bit of volatility in April, right? We saw a little bit of a correction in April. I think part of what's driving it are these handful of companies, right? You've got 7 companies that are really moving the markets right now. There's a lot of application to this AI, right? Those companies that are doing really well all have direct exposure to AI. And a lot of companies are just starting to kind of integrate those uses into their business. And so there's a lot of excitement over it.
Yeah, and I would add that the federal government, not the Federal Reserve who's trying to slow the economy, the federal government's still spending like drunken sailors, pushing money out of the economy. And I think it was back in September that the San Francisco Fed said, all right, no one's got any more COVID money left. The consumer has to slow down. And then we forgot that we all have $50,000 worth of credit in our pocket, and the consumer just keeps going. So I think, to Tyler's point, a lot of it is tied just in those 7 to 10 big stocks. But the economy, I just got an update that the expectation for GDP this quarter, so the second quarter, is to grow at 3.6%. So the economy keeps going because people keep spending money. And until that slows down, I think you have, you can see the market continue moving forward almost in spite of the Fed, unless inflation kicks back up. And the real killer would be if the market thought the Fed had to start raising rates again. And I think all bets would be off at that point.
Other questions?
I have to ask, would your portfolio allocation or philosophy change if you thought a bear market was upon us? And how would you react to a bear market scenario?
So,
Go ahead.
Well, I'm going to ask you when we're hitting 50,000, so I'll handle the easy one first. No, absolutely. And we wouldn't, if we see cracks in the market, especially the financial markets, we won't go to cash. That's not for, no one can time the market, but we have the ability to go in between these ranges. And one of the things we talked about even yesterday was having cash right now. That cash is paying us 5.25%, 5.35%. If I have a year to a year and a half of cash, I got all the staying power I need. But our investment policy committee, like I mentioned, meets regularly. And you can see us, right now we're very close to target, to our strategic targets, but we've historically gone to 5 to 7% underweight, put it into cash and just said, if the bad times come, we know we won't have to sell anything into it. But you don't want to wait until all of a sudden the floor is dropping from under you. So, Tyler.
Yeah, I was just going to, kind of say the same thing, is that we talked to a lot of our clients about this idea that, anything, you're not going to trade your way out of a bear market. You need to have made those moves prior to. And so, in the 11 years I've been at Cornerstone, right now we're sitting at a time where our clients' allocations relative to targets are really narrow, right? Meaning that we don't have these big tactical overweights or underweights to different asset classes. We're sitting very close to our targets, and including the, holding roughly 5% in cash. It was really, it's kind of easy to hold 5% in cash because we're getting yield on it. But think back to that pie chart I showed in 2022 when rates were zero, and they were zero for years before that. It was really difficult to hold cash because if you were holding cash, it meant that you weren't making any money on it, and the rest of the portfolio was, making money. So I think a lot of it's reflected right now in the fact that we're holding that cash position, that we've got fixed income exposure the way we do. Any other questions? Go ahead.
So when you, what are the fees that are associated with your work for the foundation? And how does that play into this? Is it a substantial chunk of what comes out of this?
Not as substantial as it should be. No. And Darlene may have to correct this, but the all-in, so the fee or the returns Tyler had mentioned before are already net of fees. So,
okay,
but the all-in fee, I believe, is around 0.6% per year.
That's the Cornerstone, that's the money managers, that's the custody fees, that's all in.
And when we went out a year and a half ago and did an RFP, these guys were one of two that were right in the same range as far as lowest. So, we feel like we're getting a really good value for our investment. And we tried to make sure that we were doing that for the donors. Obviously, we want to be great stewards with your money, so.
Any other questions before I turn it over to Tina? Well, again, thank you for your time. If you think of questions that you have, certainly reach out to us. We're easy to find. So, thank you.